Hello, hello. Good afternoon, everyone. Happy Sunday. Let me get an audio check here on my end. Alrighty, guys, we are good to go. Happy Sunday. Hope you guys are doing well. Glad to be here with you guys here post NFP, ready for the new week. So with that, guys, a couple things I want to touch on. Again, hope you guys had a safe weekend. Hope you guys are doing well, and hope you guys are ready to get back to making some money here this week. Keep in mind, last night, Eastern time sprung forward 1 hour, right? So keep in mind, New York daylight savings time will be different, right? So I don't want any of you guys to get up an hour late and you guys miss the session tomorrow. So do keep in mind that we are springing forward an hour. That happened last night. So New York local time will be 1 hour difference. And that's why, for example, many of you guys in your local time, you think we're an hour early, but it's just the fact that New York, again, accelerated 1 hour forward, right? So everything algorithmic, everything smart money concepts, everything related to the financial markets is all driven on New York local time, which is, again, why we always want to stick with Eastern Standard Time, or in other words, New York local time. So with that being said, that's all I had on the economic calendar side of things. Just remember that shift. It is post NFP week. So as you guys know, my favorite weeks of trade is the second, third, and fourth week after non-farm payroll week. So excited we have that behind us and looking forward to giving you guys these insights here going into the new week. So appreciate you guys joining us here this Sunday. Musa, hello. Unicorn Queen, a new week. Let's go. Absolutely. Cleo, happy Sunday. Happy Sunday, guys. Jeff, happy Sunday, my man. Hope you're doing good. Reaper, hello, hello. Kevin, my man, it's daylight saving times again. Yes, sir. Absolutely. Let's go. Happy Sunday. Happy Sunday to you as well. All right, guys. So let's get into the business, what we're looking at here for the coming week. All right, so looking at the monthly chart, we'll take it from the top here. Huge acceleration to the downside and closing below this fair value gap here. So what I'm looking at, if we stay heavy through these imbalances, because right now we've traded through this entire up close candle, right, which is a breaker block on the monthly chart. So strong close below that is indicating to me that the market is bearish. So if we start to accelerate lower, we have this monthly fair value gap as a target. Through that, we have these relatively equal lows. And that's what would be on the agenda if we continue to accelerate through these key levels. The breaker, whenever I'm using that in my analysis, is an extremely strong algorithmic level. So if we start to trade through that, that's giving me clear, decisive feedback that the market is not bullish and is in fact bearish, right? So I have to see what we get going into this week, but that's what I'm weighing out as of right now. All right, looking at the weekly chart here, you guys can see we just opened and absolutely cratered last week. Let's peel back the curtains and see what was behind that. So we have this weekly inversion fair value gap, right? Extend that through. The bodies traded up into it, but the market unable to get above it. So no ability to show strength through this, right? And an inability to get above it, which is indicating what? Weakness, right? So we had previous week's low here, this swing low back here, and then the small inefficiency that we've also now closed below. So as long as we continue accelerating on the downside, we do have this sell side here at the 103,366 level. And then through that, we have these inefficiencies here below market price. Again, if we continue to accelerate, then we have these equal lows here on the weekly chart, which could be a potential draw going into the next couple weeks. But obviously with the size of these candles that we're seeing, it could get there in much less time. So we'll have to weigh that out candle by candle, day by day. Apologies, guys. Allergies. All right, daily chart. Let's break down what we were looking at last week, right? So my goal with these live streams, right, is not to just give you guys a bias and then you guys get stuck inside that bias. My goal whenever I'm coaching, working with somebody, is for you to take these levels and be able to independently come to your own conclusions, right? So the way I'm explaining gives you that luxury. So initially, last week, what you guys will recall is we were watching this fair value gap here as a key level. Why this fair value gap? Because that's the fair value gap after this consolidation, we broke away. And then this is the first fair value gap after leaving this consolidation. So what I wanted to see, what I was measuring last week was, does the market show strength to get above this gap, or do we respect it? And that gives me all the insight I need for the direction of the daily bias and the weekly candlestick, right? So we see the market did what? On Monday, opened and completely smashed lower. Let me take that off for a second. Monday, we opened and we just completely smashed lower and displaced away from this fair value gap. So now that this fair value gap is being respected, what insight does that give us? That this here was a run on stops, repricing to the high of this fair value gap, and then an aggressive displacement away. So that right there sets everything in motion right away on Monday to give us what? A bearish bias, because it's not respecting this fair value gap. It didn't get above it, use it as support, any of the things we were looking for. So now you as a critical thinker, right, an independent thinker, you're able to look at this and say, okay, what feedback is the market giving me? It's giving me feedback that it's bearish, right? That's the benefit of, again, knowing how to read the price charts. Once we got a strong close here below this fair value gap, that's communicating what? The market is bearish, it's heavy, right? And then we got the market repricing through this low here and here, and just aggressive sell-off, large ranges to the downside. And now, again, in my opinion, the next draw here will be sell side liquidity. Let's make that red here below this low. Aggressive breakdown here, right? So aggressively trading down through this low. So as of right now, everything is bearish. One thing to watch out for could be a short-term retracement. The way I measure retracement is what you'll want to see in the lower time frames. Do we get an hourly shift in market structure? If we see that, then we could see a retracement back into the range, looking for potentially this fair value gap here and here. But again, you have to know how to read the price charts at each key level, right? So when we get to this fair value gap, you want to study, how does the market trade there? Does it keep showing strength? Then okay, we look for this fair value gap, right? Or does it trade into this one and start to show bearish structure and order flow in the lower time frame, right? Those are things you want to be able to read as you're looking at the markets throughout the week, so that you're able to be flexible and take, again, what the market is giving you. In the markets, it's not about right or wrong. It's about, are you making money? So let's go ahead and extend this level through. We can see this inversion fair value gap completely melted down through it. So just at a basic level, reading order flow using fair value gaps, we have what? This fair value gap being respected and the fair value gap below it being traded down to and through. The easiest, most simple way to read order flow. Are fair value gaps being respected in a bullish way, or are they being respected in a bearish way? Easiest way to read order flow in under 10 seconds. Hourly chart, looking at the hourly chart, it's a really nice sell-off last week. You'll see each fair value gap trade up into, respected, imbalance, hit, respected, fair value gap, respected. Just a really nice sell-off here last week. So what would tell me the market's likely to retrace back into the range and rebalance some of these inefficiencies on the downside? First would be a run on stops and then a shift in market structure. But we have to see displacement on the upside and work higher to qualify the market retracing. As of right now, though, the sell side here is the level of interest. And then if we continue accelerating through that, then again, on the weekly chart, we have the imbalances here below market price, this one here and here. And then if we really accelerate, again, we have sell side back here. Alrighty, so that's the business for dollar. Looking at the bond market, they delivered the targets we were looking for here last week. If you guys recall, we were looking for a buy side here, right? So this swing high here and here. So let me put that on all the respective bond triad. So looking at these here, right, we saw the market do what? It expanded higher and took out the buy side. But then how did we trade there? Strong rejection to the downside. And very important, one of the bond treasuries did not reach that high, giving us what? An S&T divergence. So as of right now, I'm looking at this as a run on buy stops in a premium. Why is that a premium? Because if we measure the range high down to the range low, above equilibrium is what? A premium market, right? So they repriced it higher into a premium market and taking out buy side liquidity. From there, we've seen an aggressive rejection lower. So as of right now, working down into our daily chart, as long as we remain below this recent up close candle, want to make sure I'm selecting the right order block. Yeah, so this up close candle here, as long as you remain below that, looking for lower prices, and then just as of right now, we can look for this fair value gap here and here. We have a range low, range high, right? So that would be the dealing range on the daily chart, right? So it's very important to anchor the dealing range to the time frame that you're analyzing. So daily chart. This low to this high is the range on the daily, right? So it's reasonable to see the market trade into a short-term discount as long as you remain above this up close candle. I do suspect we will accelerate through that and work down into these lows here, but that's something we'll worry about when we get there here over the next couple weeks. Alrighty. And then again, the SMT divergence already brought that up. So again, this, the 10-month treasury bonds did not take out the highs. Very important, so potentially signaling SMT divergence. And then we got a strong rejection after taking out the buy side, right? So in my mind, they've repriced it to a premium on that weekly chart. And now we're going to see continuation to the downside, or another way to put it would be internal range liquidity to external range liquidity. All right, moving right along into the NASDAQ. Take off the buy and sell buttons. Very heavy market, right? And same thing as I gave you guys on dollar, right? My goal is to give you guys the key levels that I'm using for the week to measure the bias and where we're going, right? So again, with dollar, that was this fair value gap here. And you can see how as soon as we broke down through that, that's all you need. The market's communicating it's bearish. What was the key level that we were using for NASDAQ last week? We'll get into that in the daily chart. So looking at the weekly chart last week, open, traded higher, and then aggressively sinking lower into the sell side here, and then trading into this last down close candle here. I don't think the sell-off is over yet for indices. I think indices are extremely bearish, very heavy, and looking for continued downside. If we do get signs of a retracement and the market pulls back into the range, then that's something I'll share with you guys. I will start being more active going forward, sharing my analysis publicly. Of course, those that are in the mentorship community, obviously they're getting my opinion every single trading day. However, I will be more active going forward in sharing my analysis and what I'm looking at for the public community as well in our free Discord. So I'll also be making that available more to you guys going forward. That's something I'll make more of an effort to do. I already have a lot on my plate with everything I'm having to juggle, but giving you guys analysis throughout the week, updating you guys is something that I will be doing much more so, especially now that the trading's picking up going into the month of March. All right, so working down into the daily chart. Again, we had these equal lows back here, right? So we had this low here that's relatively equal to this one, and the market's been gravitating down to these levels. What you guys will recall is the key level I gave you guys for NASDAQ was this fair value gap here. Why this one? Because that's where we were trading going into Monday at the start of the week. I said if we get through this gap here, then it's reasonable to see the market trade into these highs here and then into this fair value gap. But the market ended up doing what on Monday? Trading higher and then slamming lower, trading away from this gap here. So that immediately gives me the insight to do what? Look for lower prices. And just about all the money I made trading this week was on the short end. I did take a couple counter trend trades on, I believe it was on, is it Monday or Tuesday? I can't recall if it was Monday or Tuesday, but for the most part, the point is my focus is trading in line with that weekly and that daily candlestick. So when I'm tape reading, calling setups, sharing where the market should go, it's all on the basis of looking for lower prices in line with that higher time frame. Oh, by the way, forgot to mention, we got everything resolved with OBS, so the stream shouldn't be freezing up anymore. So wanted to also note that. Should have said that at the beginning. So daily fair value gap here again was respected, and then the market sold off. So now that gives us feedback to look for what? Lower prices. Why? Because the market is respecting this gap here. So this gap here being respected, sending price lower. So now what does that make this up close candle here? A bearish order block, right? My man Tommy sending that into the community chat. So again, up close candle, bearish order block, market respects it. Where's it gonna go? Sell side here. Whoops, here and here. And that was the basis of what we were looking for here in the previous week. Now that we've reached several key levels, is the market going to retrace? Personally, I'm not trying to call a bottom in this market. You guys know what happens when you pick your bottom. You get smelly fingers. I don't want any of you guys to have smelly fingers. So we want to trade in line with the higher time frame, weekly, daily institutional order flow. A retracement will be confirmed in the lower time frame. What do I mean? What I would look for if the market's going to retrace back to equilibrium would be a run on stops, shift in market structure, and things that would tell me in the lower time frame that we're going to see a reversal. But as of right now, staying in line with the bearish bias, as long as you remain below these two wicks here, so this wick here and this wick here, as long as you remain below that, I'm expecting the market to remain heavy. If we get up through these 2 wicks here and we start to trade up through that, then that would likely indicate to me that we're going to see a longer term retracement into this range high to range low when that range is created. On the downside though, still favoring sell side. So we have this low here that is now relatively equal to this one. And then through that, we have the daily fair value gap down here, right? So we have this imbalance and these relatively equal lows. In my opinion, that's what I'm still focused on. Again, I'm not trying to call a bottom in this market. Breakaway gap here and here, signaling the market is extremely bearish. Again, we don't want to try to pick a bottom in a market that is cratering to the downside. So in my mind, we still have lower prices to come for index futures. All right, so let's go to the hourly time frame. So we have a lot of buy side here and here with these relatively equal highs. But again, something that's very important to keep in mind, right, is, for example, we have the Monday open here, right? So Monday opens here, and here we're trading. Yes, there's equal highs on the hourly chart here and here. But did the market go to them? No, it didn't. Why is that? Very important to keep in mind. This is something I was discussing with the gentleman in mentorship as well, which is the higher time frame is always going to be parent to the lower time frame. So yes, there may be 15-minute equal highs, hourly equal highs, 1-minute equal highs. However, what's going to be more important? What's going to take more precedence over that? The higher time frame, weekly chart that's bearish, and daily chart. So don't get sucked into the lower time frames. This is a common mistake, and it's one I made a lot as well, right? Because it's what we're trained to look for, right? Equal highs, the market should draw to those equal highs. But when is it not going to draw to the equal highs? When the higher time frame is bearish. Higher time frame meaning weekly, daily chart. So it's a matter of when you're analyzing, there's a hierarchy of how you want to look at price action. The higher time frame is always going to be more influential and more impactful over price delivery than the lower time frames. So it's really easy to get stuck into looking for higher prices here and here, but the market's in an overall downtrend or bearish institutional order flow. So when that's the case, the market will many times leave these highs here and not revisit them. Why is that? Now you know. The weekly and the daily chart is going to be significantly more impactful on price delivery than these intraday, not that the hourly is intraday, but these lower time frames like hourly, 15.5 and 1-minute chart. So pro tip there to keep in mind, don't fade the daily and the weekly candlestick. In the narrative that you're going to be looking for intraday, when you're studying price action, your framing narrative, it's all going to be based off the daily chart. So daily chart is going to give you your intraday narrative for what we want to see in price action. And that's been bearish here this past week. So with that in mind, guys, that's what I'm looking at here. What would set the stage for a run higher into the buy stops here and potentially back here? Well, we would need to see a shift in order flow. What does that mean? Well, at a basic level, what I'll give you guys here for free on YouTube without going into hour-long masterclass, what highs are being displaced through and which highs are being rejected. What we see here when the market's bearish, highs rejected. Lows are being displaced through, right? Lows displaced through. This high here, we trade above this high, it's being rejected, then we're displacing through lows. Now we have this longer term high here. Market trades above it, and then we reject it. Lows are being displaced through. This high here being traded through, but it's what? Rejected. Lows are being displaced through. Same thing here at 8:30 on non-farm payroll. They run it higher. Highs are being rejected. Lows are being displaced through. So that's just a basic way, right? That's like first month basic content to how to read institutional order flow. So as long as I see that, there's nothing bearish to go short on. Or sorry, there's nothing bullish to go long on. Everything is still focusing on sell side flows or lower prices. If we see intermediate term highs taken out and displaced through, then that could set the stage for a potential retracement, right? So if we take out a key intermediate term high, that could potentially set the stage for a run higher into buy stops here and here, which again is reasonable after seeing the market drop a lot. But again, you have to balance wanting to see a retracement with the market that's bearish, right? So if it's bearish, you want to stay looking for lower prices until you get clues in order flow and market structure that the market's going to turn higher and attack buy stops. So about 27 minutes in, yeah, so they're pretty good. Got through everything in about 25 minutes. All right, guys, I'll take any questions that you guys have here before I get going. looking to keep this one here short and sweet. I do have some things to get to here on this Sunday. So any questions for me here before we get going, guys? I know it's an hour early, and for a lot of the folks that are in other countries, it's whole different time for you guys. But as always, the recording will be uploaded for those of you guys that weren't able to be here live for the entire session. Hello, Sir Jambo from Kenya. Quite a few folks from Kenya tuning in. Big shout out to Kenya. And Bitcoin getting slaughtered. So if you guys recall, last Sunday when we were speaking, right, this retracement here was just a retracement to a premium to continue lower, right? And I kept you guys ahead of that because what these retracements are designed to do, right, again, is get people to see we traded from 78 down to 95, up to 95. So a lot of folks thinking that they're going to miss the next run back up to 100K. But all it's doing is retracing, smart money selling into that rally, distributing their long positions, creating exit liquidity for people that are just chasing the market around, not knowing what they're looking for. But this gap here respected. So in my mind, we are going much lower on Bitcoin and much lower on Ethereum. So if you guys like Bitcoin at 100,000, you guys will really like it at 49,000. And then looking at the weekly chart. Yeah, we'll take it day by day. So next draw here in my mind is this fair value gap here in the 75,000. If we accelerate through that, then we have the low back here at the 47s, but that's something we'll consider when we get there. Reaper in the 1 hour time frame isn't a change in state of delivery. I believe you're referring to the 1 hour. So these two down close candles here, is that a change in state of delivery? Yeah, that's a good question. It could be. It could be. I am very cautious with calling for a change in state of delivery when higher time frame order flow is bearish, right? So one of the key things to understanding the change in state of delivery is understanding the context of a bearish order block being created, right? And unfortunately, I've seen a lot of people just look at, oh, down close candle violated here to the upside. That's a change in state of delivery. We have to go higher, and then it rolls over. Right, oh, up close candle here, down close candle, we trade through it. That's a change in state of delivery. We're bullish, right? And it keeps rolling lower. So you still want to keep in mind that higher time frame order flow. What would tell me this is a change in state of delivery? Do we respect that? Right. So do we respect this opening price, extend that through? If it's respected and we don't melt down through it, we start to see institutional sponsorship and displace away from it, then I would be able to qualify that as a change in state of delivery. But again, what did I just teach? The weekly and the daily chart is going to be a lot more important than your patterns on the lower time frame. So my focus is lower prices, but I also gave you what will confirm it as a change in state of delivery, right? So if this opening price is respected again and we displace away from it, then that's insight that I will use to then qualify that as a valid change in state of delivery to then look for higher prices. So good question. Cleo, thanks for the session. Yeah, my pleasure. Kevin, how did you do trading NFP Friday? Yeah, great question, Kevin. So I personally did not trade. Have a lot going on in my personal life. Grandmother not doing too well, so I have a lot going on in my personal life. I was visiting her in the hospital here the previous day. I was away from my setup. I had to travel I had to do some traveling that Thursday evening into Friday. So not only was I live tape reading on Friday with the community, not at my usual setup, but I had a lot going on in my personal life. And one of the things that I've learned is through experience, if I just trade every day when I'm not as locked in as I should be, and I have a lot going on in my personal life, those things will influence me. Because if I come into the market and I want to just bury my hatchet in someone's skull, that's not a good mindset to come in and trade. And you guys are laughing because you guys have all been through it as well, right? You're either sick, you're feeling bad, so you want to come to the market to do what? Feel better. Well, how did that work out? Probably not well, right? You have something going on. Maybe you lost a family member. Maybe something's going on. And you try to trade during those times. What usually happens? You don't need me to tell you. So for me personally, in my personal life, when I notice that things aren't in a place for me to be as dialed in as I need to be, I won't risk money. Because when you're risking $2,000-$3,000 per transaction, your mindset shifts a lot, right? So it's not just for me getting action every single day I'm in front of the charts. It's taking the highest quality trades when I'm the most dialed in. Because if I go on tilt, that can end me, right? So that can be a problem. Because if I go on tilt and I lose the big accounts I'm trading, now that's not just some fuck around, do a reset, right, on a funded account challenge. Like it's some damage to me. So one of the things that I'm mostly focused on when I'm trading is making sure that I'm able to be dialed in and not have outside things influencing me. And I need to know myself enough, and this is going to be helpful for you guys and hopefully me sharing my personal experience, is I need to know enough about myself to know when I'm dialed in and when I'm not. So if I'm not as dialed in, I won't take trades. So long story short, did not do anything on Friday, but absolutely put on a price action clinic with the mentorship group, of course, keeping their learning going forward every single trading day. So that was what I was doing on Friday, but no trades on my end. If I would have traded, I probably would have been 1 for 2, maybe 2 for 3, based off the way it delivered. But yeah, that was my action on Friday. So just calling the market, sharing what I was looking for, and taking it light on my end on the trading side. Because as you guys know, my protocols, once I'm up Monday, Tuesday, generally I keep it light the remainder of the week. Yeah, good question though, Kevin. Sorry to hear about your grandmother. Best wishes. Really appreciate you guys. Thank you very much. Appreciate all your support, guys. I'll keep her in my prayers. Really appreciate you guys. Thank you very much. And thank you very much. Really do appreciate you guys. Can take a look at oil? Yeah, James, I got you. Let's take a look at oil. So oil, with the drawn liquidity that I gave you guys, has been delivering the script here. So if you guys recall, for the last, I'd say 3 weeks, we've been looking for lower prices on oil, looking for these relatively equal lows here, right? Sorry, here and here, right? So we're seeing clear bearish order flow, right? Fair value gap here being respected. Up close candle is a bearish order block. So market trades up into the bearish order block, respects this level, displaces lower. Lows are being what? Displaced through. So in my opinion, the drawn liquidity here is the 64.75 level. So that's what I'm looking at here for crude oil daily chart. Order flow is very heavy. We're bearish. I see this as a measuring gap here. Why is that a measuring gap? Well, because if when we were up here, I'm telling you the market's likely to draw down into here, you can measure the unrealized range. And for those of you guys that are working with me directly, don't worry, we'll get into all these details. I'll teach you all these advanced things, but we have to get through the basics first, right? Once I get you guys through the basics, then we'll go into all the crazy PhD level shit you can do with all this stuff. Why is this a measuring gap? In my analysis, this is a measuring gap because this is where the price run started. And this is the price run I want to see materialized in price action. I want to see us get down into here. So what we're able to do is grade that price swing, or grade the predicted price swing that we're looking for. It's called an implied dealing range. It's a little more advanced because you have to know where the market's going. Of course, as with all these concepts, they don't work. Bearish order blocks don't work. Fair value gaps don't work. Measuring gaps don't work. None of it works if you don't know where the market's showing, right? So number one, you have to know where the market's likely to trade to. Once you have that idea that the market's likely going to want to work down here, and this is where the price run is starting, at the beginning of the price run, we want to see what? A breakaway gap. That goes without being said, because then it indicates we're likely going to see a clean, explosive price run lower, and that's what we've been seeing. At 50% of the price run, I also want to see a breakaway gap as well. But by classification, it's a measuring gap because it's at 50% of the price run. So if it creates a breakaway gap and leaves it open at 50%, it becomes a measuring gap, because then what we're able to do is if they left this gap open, it's further confirming, further solidifying that they're likely going to want to take it down into the full target. So what we can do is duplicate the range. So from this high to this low, anchor to the measuring gap, extend that -1 standard deviation, and then you get this low here. So if you get a measuring gap, it's further confirmation that the entire run's going to materialize. That's exactly what I wanted to see here. Market broke down, and then we still have these equal lows to work with here for crude oil. Chris, when looking left on the higher time frame, when, for instance, the lows to the left on the current contract are spotty or low volume price action, when do you use the continuous contract to reference it, if at all? Yeah, really good question, Chris. So looking at the NASDAQ, let's go up to the daily chart. We can see back here, as you mentioned, in this low volume price action, we have what? Spotty price delivery, right? Which is volume imbalances or sometimes an entire liquidity void. The data that you see with these inefficiencies is useful. So I like to see these inefficiencies. I don't look at this as something that's negative. In my mind, it's positive because the algorithm will refer to these inefficient price ranges. So if you look at the continuous contract, as you mentioned, now it smooths all that out and it uses the previous month contract. And it's not showing me these inefficiencies. Whereas in the current month contract, let's go to NASDAQ, in the current month contract, it shows these imbalances here and here, and then even on the weekly chart it may. Not as much, but you can see it here. But the algorithm, the AI that is booking price will refer to these inefficiencies. So saying that to say, I always use the current month contract, and those inefficiencies aren't a bad thing, they're a good thing because they're key levels that the algorithm will refer to and use when it's booking price. So personally, I like to use the current month contract even with the spotty price delivery. The only time I will look at the continuous here is if I'm doing like long-term macro analysis on like a monthly chart, or sometimes even the weekly. If I want to see like further back, then I will use the continuous contract. But outside of that, I'm always using the official current contract month that's being traded with the highest open interest. Yeah, great question. Issy, thanks, Dylan. Yeah, my pleasure, guys. Alrighty, folks. Don't see any more questions. Probably a bit lower attendance because of the hour change, but we'll announce that here next week earlier, so you guys have plenty of time to attend here. Like I said, really appreciate you guys joining us here today. I was getting some questions also on live tape reading. When will I be live again? I will do one live session with you guys this week. I'm not sure what day. I'll have to look at my economic calendar and get the schedule out to the clients that I'm working with. And then once I have that, I will likely make a session where I will go live with you guys and either trade or tape read, depending on what it is that I'm looking at there. And it will be lovely as usual. So with that being said, guys, appreciate you guys joining us. Jeff, thank you, brother. Appreciate you. Have a good rest of your Sunday, guys, and I will see you guys this week. Take care and stay safe, everyone.